Hi everyone, and today we are going to read about one of the company who got demerged from one of the largest private banks in India, and now they're focusing to compete with one of the largest NBFC in India, which is Bajaj Finance. And the company we are talking about is HDB Financial Services. So just a quick disclaimer that this is not a buy or sell recommendation. So let's start with the report. So currently HDB Financials is one of the largest NBFC in India. So the company was incorporated in 2007, and in 2011 they got a AAA credit rating from CARE and CRISIL, and it is a subsidiary of HDFC Bank. And according to CRISIL, HDB Financial is the second largest and the third fastest growing in the NBFC segment. And as of March 2025, they have served over 19 million customers at a 27% CAGR growth rate over the last 3 years. And one point to notice is that 73% of the loan book is secured and 27% of the loan book is unsecured. So that is a good ratio they are maintaining currently. Now, if we take a look at their presence, currently they are well established in the semi-urban and the rural areas, which is right now very under-penetrated market, and a lot of scope is there in this segment. And also they have 1,700 branches, over 1,100 towns, and across 31 states. So we can definitely say that they have a good exposure all over the India. And one of the best part is that no region currently accounts of more than 35% of the total AUM. So that way they don't have a concentration risk in any one region. If we take a look at what are the products they are offering, so they give personal loans, business loan, gold loans, auto, enterprise finances, and asset management services. And they also have fee-based services such as insurance distribution and BPO solutions. Now let's take a look at their shareholding pattern. So before issuing their shares in the public, 94% was there to the promoters and only 6% was there in the public. And currently, after their post issuance of the shares, HDB promoters have 74% and public has 26%. And from this point, we can see in the future that multiple funds will buy their stake in the open markets because the company is looking good. Now let's take a look at the image I have attached on the right hand side. So one of the interesting data point is that loan against property consist of 21% of their AUM, and commercial vehicle loans consist of 25% of their AUM, and the rest of the products are kind of evenly distributed. And from this data point, we got to know that which products are getting sold the most out of all the segments they have. Now let's get to the next segment, which is a very interesting data point. So this is a performance they have given across the multiple bad times during the economy. So the first bad cycle they have mentioned about is a taper tantrum, like during the 2008 Lehman crisis. After that, US government started buying more bonds in order to inject liquidity in the economy. They started the quantitative easing program, and during 2013, the government said that now they are going to reduce buying more bonds. So that created a panic among all the investors. So even during this bad time, the HDB AUM grew from 83 billion to 193 billion, which is more than double from 2013 till 2015. And also if we take a look at other parameters like AUM growth, which is almost more than 50% every year, then PAT growth is also more than 50%, then ROE more than 15%, that shows that how strong HDB is. Then the next bad cycle was the demonetization. Like even during this time, their AUM grew more than 30%. And the next bad cycle was because of the liquidity crisis, which happened because of the IL and FS financial group. So this liquidity crisis happened because they defaulted on their debt, and they had some big major shareholders like LIC, SBI and HDFC. During that time, they maintained their ROE almost to 17%. And then the next bad cycle was COVID. So in this time, overall all the NBFCs, banks or any companies, they faced a major slowdown. We can see that there was a slow growth from FY20 till FY21, and then the high growth period started where their AUM grew from 613 billion to 902 billion with the ROE of 11.2. It went up to 19%, and now in FY25 they are standing with an AUM of 1070 billion. Now let's get to the next segment, where we will compare the cost of borrowing of all the players. So here we can see that in FY20, almost all the companies had a higher cost of borrowing, and also this is obvious because during that time the COVID happened and there was a major liquidity crisis. Now if we take a look at FY25, they have reduced their cost of borrowing from 9.2% to 7.9%. And if we compare with Bajaj Finance, which is the biggest NBFC, so currently it is similar to what they have. Also, one thing to notice here is that L&T Finance has a very low cost of borrowing, but as it is not a big NBFC compared to what Bajaj Finance and HDB is, so that's why if you compare with Bajaj Finance, that is a more better thing. And now let's take a look at the image I have attached on the right hand side. So this is the data point of the HDB, that what is their current GNPA and NNPA, which is their non-performing assets. So usually a GNPA below 2 is good and the NNPA which is below 1 is good. So now from FY22, which was 4.99%, now in FY25 it is 2.26, and they are expecting by FY28 it will come down to 2%. And if we take a look at their NNPA ratio, in FY22 it was 2.35%, in FY25 they came down to 1%, and they are expecting that by FY28 it will come down to 0.91%. So from this data point we can interpret that they're going to make their loan books more cleaner. Now let's get to the next segment, which is the revenue segment, and they have 3 revenue segments. The first is the enterprise lending. So in this part they give loans to small businesses, as small businesses need money for working capital and in order to do capex. And if you take a look at the loan size, it consists between 25,000 to 250 million. The tenure is up to 15 years, and they provide both the secured and unsecured loans. And in the secured loans they give a rate of 9 to 18%, and in the unsecured part they can give from 11% up to 30% of the rate. Currently they are located in more than 900 locations. Their gross loans in this segment is around 420 billions. Now let's come to the next revenue segment, which is the asset finance. So in this segment they give loans to multiple customers, which include the fleet owners, also someone who has used vehicle, so they give their vehicle as a secured asset. And in this segment they only provide secured loans. So their currently loan size consists of 1 lakh rupees to 250 millions, and the tenure is up to 6 years. And if you take a look at the interest rate they provide, it is around 9% to 18%, which is fixed. And currently it is also located to more than 900 locations. Their gross loans is around 406 billions. And now the last revenue segment is the consumer finance, and here they give loans to people who want to buy two-wheelers, autos, or micro loan, personal loan, etc. And the loan size in this segment is 4,000 to 5 million. The tenure is up to 7 years, and the interest rate in this part is around 11% to 34%, as personal loans have higher interest rates. So here they provide both type of loans, which is secured and unsecured, and currently they are located in more than 1,000 locations. And if you take a look at the gross loans they have in this segment is around 240 billions. Now let's take a look at the image I have attached on the right hand side, which is the 3 revenue segments. So in FY22, 49% was consisting enterprise lending and 13% was only of consumer finance. But now if you take a look at FY25, so the consumer finance segment has grown up from 13% to 23%. And this is also obvious because now people have more money in the pocket and now they are spending more. So the good thing is that if people are spending more money, our economy will grow. But there is also a bad part. So as Indians, we have a very bad habit of paying premiums to products which are not that useful. And we also see that people are buying things by taking out loans which they can't even afford. So these are the two sides of this segment. And also, if we take a look at the next 3 years, it is going to get stabilized. And now let's get to the next segment, which is the financial analysis. So this is the data point which is shared by MK Global Financial Services. So in FY25, they gave a revenue of 13,800 crores and their total income was 9,900 crores. But if we take a look at FY26, they are expecting that their net interest income is going to grow at 25%. So that's a good number. Also, if we take a look at the PAT growth, it is going to be 32%. Now, one of the interesting data point is that by FY28, they are expecting that their PAT, which is currently 2,176 crores, it is going to more than double by FY28, which is going to be around 4,600 crores. And now we are going to take a look at some of the financial ratios they are expecting by FY28, how they are going to perform. So here if we take a look, so these are all the players currently in the NBFC segment. And if we take a look at HDB, currently they are expecting that by FY26, their PB ratio is going to be 2.9, which is very low what Bajaj Finance is having of 5.1. And by FY28, HDB is expecting that their PB ratio is going to be 2.1. So PB ratio wise, we can say that HDB is looking good compared to Bajaj Finance. Now if we take a look at the PE ratio, even here we can see that HDB FY28 expected PE is 13.2, whereas for Bajaj Finance it is going to be 18.4. And also if we take a look at Cholamandalam, they are expecting that their P is going to be almost 16 by FY28. Now here we can see that there are other NBFCs who has lower PB ratio or lower PB ratio, but because they have a small AUM and they can't be directly compared with these companies, that's why we are majorly focusing to Bajaj Finance and Cholamandalam. Now let's take a look at the ROA part. So here Bajaj Finance is leading very well. So by FY28 they are expecting that HDB is going to have a ROA of 2.7, whereas if we take a look at Bajaj Finance, it is going to be 4.1. So that is significantly higher. And if we take a look at Cholamandalam, it is going to be 2.7. So here Bajaj Finance is a clear winner. And even if we take a look at ROE, by FY28 their ROE is going to be 21.5%, which is still higher than what HDB is having of 17%. And if we take a look at Cholamandalam, it is almost similar to what Bajaj Finance they are expecting. So to summarize this part, if you look at PB ratio, HDB is leading over there. But if we take a look at ROA and ROE part, Bajaj Finance is completely leading and dominating in this part. Now let's get to the next segment, which is the AUM growth they are expecting. So currently Bajaj Finance has the largest AUM of 4,100 billion. They are expecting that the CAGR growth is going to be the fastest for Bajaj Finance, which is 24.3%, whereas for HDB they are expecting that it is going to be 20.2%. And if we take a look at Cholamandalam, it is going to be 21.5%. So again here Bajaj Finance is leading and they're going to grow fast, which is the expectation given by MK. So here we can again see that Bajaj Finance is completely dominating and they're going to grow faster than the other NBFCs. So the interesting data point is that Bajaj Finance is the only company which give loans to all the segments and they have that cross-selling product in their portfolio. So that's why Bajaj Finance is the dominating player in the NBFC segment. And now let's go to the next segment, which is the SWOT analysis. So here we will look at their strength, weakness, opportunities and the threats. So one of the strengths we already read about is that they have a diversified AUM and also they have a very large clientele. And if we take a look at their weaknesses, so they have more regulatory burden and they have more governance requirements they need to follow. And if we take a look at their opportunity wise, currently they can see growth potential in the gold loans and the microfinancial loans. And if we take a look at their threats, so after the IPO, so the parent company can't hold more than 20% and they need to reduce their stake. So according to the RBI norms, they need to reduce their holdings in the company, and because of this reason they can see the impact in the business, financial and the valuation part. And now let's get to the last segment, which is the technical analysis. So we can't do tech analysis on HDB as it is recently listed, but we can take a look on Bajaj Finance. So from FY21 till Feb 2025, it was consolidating in a range, and one of the main reason was it was trading at a very higher valuation. So during that time it was trading at a PE of 100, and during this time the PE was re-rating, and now currently it is trading at a PE of 34.5, which is reasonable. And also recently they broke the consolidation phase, and now currently it is trading in an upward momentum at a price of 925 rupees. So to summarize this, in my opinion, so HDB is growing, but as Bajaj Finance is already a dominant player, they have presence across all the geographies and they have a more stronger clientele base. So that's why I'm more bullish on Bajaj Finance. But obviously as HDB has also a good brand name and a good reputation, so here we can see a good competition among these two NBFCs. So thank you for watching this video, and after reading all these data points, which company is going to grow much faster, whether it's HDB or Bajaj Finance, you write down your opinions in the comment section. Until then, see you in the next video.